Hello, everyone. Welcome back. I'm Vince Rocco in New York, where the state of our industry is concerned. So let's get right to what everyone is talking about. Buying property in New York City is far more than the purchase price. Today, we are unpacking the true cost of owning in New York City, the expenses that often surprise buyers long after the closing table. From monthly carrying costs and common charges to unexpected assessments, property taxes, and rising insurance premiums, ownership in this market comes with layers of financial responsibility that demand careful planning. Whether you're considering a co-op, a condo, or a townhouse, understanding these costs upfront can mean the difference between a comfortable ownership experience and a financial strain. This conversation is about clarity, preparedness, and making smarter, more informed decisions in one of the most complex real estate markets in the world. And on set with me here today are Ryan Kaplan from Corcoran, John Harrison from Core, and David Rodriguez from Cross Country Mortgage. And they join me now to discuss, but first, let me welcome my listeners and viewers from across the United States and all around the globe. This is Talking New York Real Estate. So let's get behind the headlines and inside the state of our industry.
Hi, it's Stephen Bailey from Roadway Moving and Storage. Listening to Vince Rocco, you know the right partner makes all the difference. At Roadway, we deliver an experience your clients will love. For specialized services and white glove care, choose Roadway. Want to learn more? Email me at steven@roadwaymoving.com or visit roadwaymoving.com.
Okay, everybody, we are back. So we're down one guest today. Unfortunately, Peter Grabard, our attorney that was going to join us today, had an emergency at home. Everything is okay, but he's going to miss this episode, but we'll be back in the coming future. We're going to talk today about the true cost of ownership. You know, when you get into buying real estate here in New York City especially, but anywhere, you know, it costs something. And sometimes it ends up costing more than we plan on, more than we anticipate, or we can get ourselves in trouble if we don't really understand everything that goes into the cost behind a purchase price, the monthly charges, the taxes, real estate taxes, maintenance, whatever. So here in New York, we are special, and I like to say that we are special. And with that being special, so is our real estate. John, let me start with you. When buyers think about the total cost of owning in New York City, what do they often misunderstand or overlook? What don't they get in their initial thinking of what it may cost me ultimately as a buyer?
It's a great question. And a lot of people, of course, come to New York having heard about or learned about owning in another city, in another location. So they have their ideas that maybe they're going to pay some insurance, real estate taxes. But in the city, we have common charges and maintenance taxes. And sometimes those can be surprisingly higher than what people expect. In Manhattan, I think that our average for service building could be in the $3 per foot or so range. One of my favorite analogies that I heard from a great friend said one time, there's a big difference between somebody giving you free puppies versus free beer. One of them is actually free, and the other one comes with a lot of responsibility. So
but
one
I
of
want
the
to hug
things,
those puppies.
I know, listen.
Beer, right?
But that's just it. If you want to take care of puppies, it's great. But when people are looking online at the sticker price of a property, and they fail to look at what the ongoing carrying costs are, it can be a shock when they aren't expecting the many thousands of dollars a month that they're going to pay on top of whatever their mortgage might be.
We're going to talk about that in a little bit. But Ryan, let me ask you, so, how different is the total cost of ownership today than it was, say, 5 years ago or 10 years ago? Obviously, the market fluctuates, the market changes. What was present then and what's present today?
Yeah, like many things in the world right now, costs just keep going up. Mm-hmm. And when you are part of a collective, when you're part of a co-op or a condominium, your fees are tethered to the maintenance thereof of said property, replacement costs, staffing if it's a doorman building, superintendent, et cetera. So as minimum wage goes up, as the cost of materials to do capital expenditures go up, you are constantly, and myself included being an owner, I own in a co-op, are being called upon to spend more money than what it would have cost to redo your roof 5 to 7 years ago. Your property taxes are ever escalating. So the list goes on and on. But yes, it is ever going up. But that's why you got to buy smart. So that way it ends up making sense in the end of it.
You have to buy smart. And what I'm seeing in the last year, actually exactly a year ago, January 2025, and then into this year, the double-digit increase in maintenance.
Yeah.
Where we used to get 3% and 4%, now we're talking 10%.
Yeah.
In some cases, 11%. Now, you do the math and you figure out 10% more than last year. That's just my maintenance.
Yeah.
Now, if I'm in a condo, my real estate taxes are going up. I mean, that's for absolute certainty. Everybody complains about the cost of premium for insurance policy, right? I mean, we can go on and on and on and on. The cost of electric. I just got, a note from Con Ed the other day. Your new monthly bill is going to be higher than last month. And I'm like, really? Really? Isn't that something?
Yeah.
Okay.
And the insurance thing, especially if you look at markets outside of New York, like that are very weather susceptible. If you look at the markets in California where there's been fires and mudslides,
Right.
you look in Florida where there's hurricanes and flooding, the insurance premiums there have gone up tremendously.
Yeah.
In New York, it's not even as bad as those.
And
Even in the Hamptons, like people
Yeah.
are getting cut off left and right because a lot of insurance agencies don't want to be
yeah,
there.
the floods
So.
are-
100%.
Yeah.
And what we always say, what goes up doesn't always come down.
Right. That's
Okay.
right.
So when they go up, that's going to stay there and they're not coming down. David, when you're working with first-time buyers, are they surprised with, the overall cost of the monthlies? Do they even look at that? Because, for the longest time, you can say that everybody was focused on the purchase price. Mm-hmm. If I can get a little bit of a discount on the purchase price, I feel good. My mortgage payment will be a little lower. Now we're talking about interest rates and we're talking about double-digit maintenance. Are they paying attention to the monthlies as much as they used to pay attention to purchase price today, first-time buyers?
So funny enough, it's actually one of the first questions I ask. We always start with like, what's your price point? And then I go, what is your monthly budget, right? Because I actually back into the numbers. Like a lot of people say, I spend right now $5,000 on rent, and I'm willing to go to $6,000. So I back the numbers up into $6,000, and I show them, okay, if you're looking at the price point you want, like here's the mortgage payment. But you notice we don't have a lot of room for maintenance and taxes. So we have to really be cognizant. We have to speak with the agent and pair with them to say, hey, our range is really tight here if we're going to go to this price point. So it's educating the client on, there's three major components: the mortgage, the taxes, the maintenance, or maintenance on co-op. And we're focusing on that monthly budget because at the end of the day, the purchase price is one thing, but really we're in the monthly payment business for first-time buyers, right? They're going from rent to
Exactly.
spending.
And rent, and we all know, we'll talk a little bit later about the rental market here in New York. It's gone sky high. I mean, to coin a phrase. And I just did a renewal, and we'll talk about that a little later on. But John, I think you touched on a little while ago, what actually goes into what we call monthly cost? I mean, you mentioned, door staff and whatever. What actually goes into the monthly cost?
Well, and this is where
In a co-op, a condo?
Sure. Well, this is where it's important to look at the different buildings that a person would live in, because I've had people that have said, well, I love this building and everything about it, but the monthly costs are so much greater than this other building I found. And I would ask, would you live in that other building? And they may say, never. So I'd say, okay, well, then you can't really compare it to that. Maybe you'd have to compare it to what it costs to rent in a similar building. Yeah. But you have things like the staff. Of course, if there is a doorman or a concierge, if there's a super, if you have an elevator, if you have a gym, you have all of these things, the lighting inside the hallways, the exterior of the building, everything outside of your walls is a part of what the building has to pay for. And so part of your ongoing monthly either common charges in a condo or maintenance in a co-op has to go to pay for all of that. And that goes down to the raw materials. If there is an annual budget to review repairs, it's actually cheaper for most buildings to maintain their buildings versus waiting until things get to a catastrophic level and then they have to do a major capital spend. So a lot of things go into maintaining a building, but this is where you have to really consider the buildings that you're looking at. Do they create the life experience that you want to have? Because at the end of this, if you're buying or if you're renting, all you're really walking away with is the life experience. If you own, you also get a little bit of equity. So that's kind of the value of purchasing.
But I like that life experience. Ryan, when you're talking to clients, okay, about the overall carrying cost, do they put a lot of stock into what the total monthlies will be in the future, or are they only worried about, I qualify today, I can get in today, my mortgage banker tells me I'm good, but what about a year from now? What about 3 or 4 years from now when prices are going to increase, as we've talked about, significantly year by year? Do they think about the future?
They might not be thinking about it, but I am. Yep. So when I'm underwriting,
of course you are.
So one of the main things I do with my buy-side clients when we're underwriting deals, it's not just what is the price per square foot of this unit vis-a-vis something else that's sold in the same building. It's what are the common charges in this building and the taxes per square foot, and how does that comp to all the neighbors? And are they higher than normal? Are they lower than normal? And usually if they're higher than normal, unless there are additional services in the building, you have a swimming pool or a bowling alley or a helipad or something that's substantial, substantiates why the carrying is more. If they're just higher, that's usually an indicator of poor financial health. So then it's a clue when you're doing your due diligence, if you have a savvy buyer's rep and a good attorney, to look at the information behind the building and the expenses. Is there any debt outstanding on the co-op? If so, is it at a high interest rate? Is it interest only? Is it maturing? Which is probably a bunch of topics that you would know quite a bit about as our loan guy. But
those are all valid points.
You have to look ahead and say, okay, they might be great right now, but this building has a loan that's coming due in 5 years. And by the way, the interest rate on it is much lower than where I know debt is today. This is definitely going to go up.
He brings up an interesting point with maybe the cost is great right now. In some circumstances, it could be wiser to spend more right now versus taking the home that has less just because it's more stable.
Yeah.
So that's why I think it's important to do what you said, which is really go through almost like an underwriting process, really examine where it's going.
Every deal we do goes through an underwriting process.
Yeah. David, so when you're dealing with buyers, first time or second or third time buyers, how, do they really, think about the high carrying cost, and how does that weigh against the purchase price? Do you hear people saying, well, I like the purchase price, I got it down to whatever, but you know what, the carrying costs are just going to be a little much for me, and I think I need to move on. Do you hear any of that at all?
We do, and the thing is also just education. So like when I start with the pre-approval, I'm a little intense. So I go through like 5 milestones of what it takes to get a mortgage: credit, income, assets, building approval, appraisal. We're going through on the income side. We know most co-ops, again, 70% of what trades in Manhattan are co-ops. So we're looking at what is our max we can spend on that 30% debt to income ratio or 28%, right? And so from there, I'm saying, okay, here's our max number. This is all we can spend for this, for a co-op, and then here's what we can spend for a condo. And a lot of times, the banks are quite generous when it comes to how much you can spend a month. So when I tell a client like, hey, on a co-op, you can only spend $5,000 versus on a condo from the bank side, you can spend up to $9,000 or $8,000. And a lot of clients are like, oh, I don't want to go that high, right? So most of the first time buyers I see come in aligned with what most boards want, which is not spending more than 30% of what they earn. And we're looking at those monthly costs, and they know higher monthly costs, less of a mortgage loan amount you can take out, meaning lower purchase price. So we're educating and we're running scenarios from day one, and I want them to understand from that first conversation how important it is that if the common charges are higher, you're going to take out a smaller loan if you want to meet that budget requirement.
I get it. We hear a lot about special assessments in this town too, and I got to tell you something. Lately, working with buyers and touring around, it seems like almost every building has a special assessment going on. John, what triggers an assessment? What is it for the listening audience and the viewers out there? What are special assessments, and why do they seem to be like constantly out there and ongoing, never ending?
Yeah, I'm putting my shield on, John, because I already know.
No, I know.
Here we go.
So, it's usually the loan. No, I'm kidding. So there are a number of reasons why. The question is, what makes a building need to spend more money? And often it could have to do with repairs that are necessary. You could have local law 11. You could have like building facade issues that, every few years the building has to have the facade inspected. And if there are any loose bricks, then by law they have to start to put up scaffolding, which costs thousands of dollars. All of these
3
things
years
happen.
And my scaffolding is still up.
Yeah, well, sometimes for some buildings it's cheaper just to keep the scaffolding up indefinitely than it is to spend the money to repair. So they have to wait until their capital or their reserves are increased. Well, how do they do that? They have to ask for more money. And if they don't have a budget that's sufficient to cover all of these repairs that come up, then that's where they have to give a special assessment, which means in theory, temporary increase in your common charges, your maintenance. But it's common for a number of reasons. Sometimes building requirements change. Sometimes the city will enact some additional requirements, maybe for safety or for various reasons. And so now there is an additional set of hurdles that the building has to jump through, and that cost. So it could be elevator failure. It could be that the cost of labor goes up and that the reserves didn't quite hit it. It could be, major repairs that are necessary. But the point is, whenever the building has to spend more than what they earn, they don't want to go through the entire budget and spend all of the dollars there, because now if they spend all of their money, banks won't lend. the banks are looking for, and it's for your benefit, by the way, but the banks won't lend in buildings if they don't have sufficient reserves. So what do? We need to ask for everybody to pitch in some more money. Usually it's positioned as a temporary thing. And I've seen a lot of buildings that will bring these special assessments up where they last for a year or 2 years and then disappear. But then sometimes the board and the building decides, you know what, let's just keep this assessment, make it a permanent increase in our monthlies so that we can build back up the reserves to where they should be.
Yeah, and in some cases, one assessment will disappear, and then immediately a month or two later, which I'm going through now in a building that I work in all the time, is right back again.
Yeah.
The cost of everything, $3 million to fix a roof. Where's the building getting that kind of money from? You raise the maintenance, but you also have to special assess for that because it's impossible.
We're even seeing so a lot of the buildings that were built from that 2012 to 2017 era, a lot of them don't have a line item on their budget for reserves because they all used when they bought, they all contributed 2 months, 3 months, whatever the sponsor required. But usually in a new construction, you contribute 2 months into the reserve account. So now a lot of these people are coming and selling and people are looking to buy in these buildings are finally turning over. And the banks look at the financials and they're like, you don't have, reserves. And banks in general around the country, kind of the standard Fannie Mae rule, which Fannie Mae is the gospel for most underwriting for any bank. And again, every bank deviates after that. But the general rule of thumb is you have to have on income. So if you earn $100,000 a year, or sorry, let's say $1 million a year, you have to have 10% of that income going towards reserves. So you have your income line item and then you have your expense line item. And if the bank doesn't see on that expense line item, 10% of $1 million or $100,000 going specifically to capital improvements and reserves, a lot of banks will not lend in certain circumstances for that client. Now, there's other ways around it, but that's the general rule of thumb. So we're really trying to educate and coach, especially all the boards in the area. We want to see that. And on co-op, most co-ops don't put a reserve line item in their budget, but the banks still like to see that in their operating accounts, they have at least 10% of the income in an operating account that they can tap if needed. So reserves are super important, and that's one of the, again, when I'm talking about the 5 milestones, we're always asking when we're making offers, we're checking financials from the get-go.
Yeah, I mean, reserves are definitely important, but a lot of buildings don't have them.
Correct.
So again, assessing and as Ryan said before, going out, if it's a co-op, getting more money, higher interest rates these days. We're going to talk about all that, including interest rate, right after these messages. This is Talking New York Real Estate on the More Network in New York City. We will be right back. Don't go anywhere.
I'm Brian Scott Cohen, one of the top loan originators in the country, and the #1 mortgage originator at Guaranteed Rate Affinity. Guaranteed Rate Affinity arguably has the most advanced tech in the industry. Our completely digital loan process makes it easy and efficient for homeowners, from a 15-minute pre-approval to the digital application and through closing. My team and I would love to help you get into the home of your dreams.
From residential and commercial closings to litigation, Romer DeBoss is your full-service real estate law firm. We blend big firm knowledge with boutique-level attention, delivering outcomes that exceed every expectation. Contact us at romerdeboss.com.
And we're back. Okay, everybody, we are back. So, Ryan, let me, I just mentioned before the break, interest rates. And, a couple of weeks ago and for a couple of weeks, we've been talking about as we are entering 2026, we don't feel, several guests of mine and myself don't feel that interest rate is going to be the main topic. And David laughs every time I bring up interest rate. Because I think our problem this year is going to be more inventory or lack of. Do you agree with that? I mean, interest rate is important when we talk about the total cost of ownership and buying power and buying potential. But what about inventory?
Yeah, I mean, inventory, at least as far as New York City goes, it is the main reason and the main driver behind price accretion over the last several years, especially in the historic districts. So you look at neighborhoods like the prime Brooklyn's on fire. You want to do deals in Brooklyn Heights or Park Slope, Cobble Hill. It's unbelievably competitive. Yeah. You underwrite all the latest comps. You get to your number. You add a 10% stupid premium on top of that, and then it goes for even more than that. I mean, I've been in so many. Truly, I've been.
Well said.
I've been in a number of bidding wars where I've seen things. Buyers of mine have lost because I've seen things go for irresponsibly high valuations or seemingly irresponsible, and that's because When you have landmarks, which is a good thing, it keeps the character of these great neighborhoods, whether I mentioned Brooklyn, but we have it in Manhattan too, all over the city, West Village, Tribeca, Uptown, et cetera. You maintain the integrity, the architectural integrity and the vibe of a neighborhood. However, it stifles towers from being built, from density, from what we would need to do theoretically in normal economics to satiate demand. You cannot create the supply. So that is why prices keep going up.
John, your opinion on that? I mean, inventory this year versus, the total cost of ownership regarding interest rate?
Yeah, so I agree. The interest rate, whenever there was when we had the big shock where interest rates started to soar, that became the main talking point. And there's always going to be some main talking point. It's either everyone's leaving the city because of COVID, it's going to be the mayoral election, it's going to be whatever it is, there's always going to be something. But the truth is, we've seen a decrease in the addition of new supply for a while now. So the pipeline that we've seen for new development has not kept up with the increase in the number of households, not just the population, because when someone's born, they don't go and buy a house, but the population in terms of households has been outpacing the supply. So of course, inventory is going to be a problem. And within the real estate world, we've been talking about this for a while, because a lot of times buyers don't necessarily look at that pipeline of supply. We see it, and it seems pretty obvious that that's creating a problem.
David, how can buyers identify any red flags from a financial perspective in buildings before they purchase? I mean, obviously you have good conversations with them. They have conversations with their brokers or their agents. How can buyers recognize red flags? And when they do, what do they do about it? Or what do you advise they do about it?
I always teach like the gut check and don't stare at my gut.
Okay.
Everyone suck it in. And so first things first, if you walk into a building and you see scaffolding, you have to let everybody on your team know. If you've already hired an attorney, if you have you're a mortgage banker, I need to know that from day one. If I see also on a listing, if I see an assessment is listed, I'm creeping on the previous sales, and I want to see, has that assessment been going on for 4 or 5 years? And something we didn't mention, back in the old days, co-ops would never raise their maintenance, so that in theory it would price better, lower maintenance, better price on the co-op. That has kind of changed a little bit, but I'm looking for assessments. I'm looking for the scaffolding. And then once a client has that, maybe it's a yellow flag that's coming off, that's where we get on the phone and we start checking everything. Department of Buildings. I'm checking, or also, for example, new construction. I keep mentioning that. New construction in Brooklyn is everything right now, right? So I'm checking the Attorney General's office. I want to see what amendments have been filed. I want to see where they are on their pre-sales. I can take a look at all of that ahead of time. And this is why it's imperative, and I wish Peter were here, because it's imperative to have New York City-based people. If you have an attorney that is in Syosset, Melville, wherever they are, right?
Syracuse, New York, I had last year.
Oh, they have no idea how to understand these components, right? And then you also get these outside attorneys, especially on a co-op. If we see scaffolding, if we see assessments, that attorney needs to read minutes when that offer gets accepted. And you know how many attorneys outside the city refuse to read minutes? And then
Syracuse, New York.
And then here's the crazier one. I have these clients that work for big companies, and when you work for a big company, you can sign up for this like attorney, like you pay a monthly fee, and it goes to like MetLife attorneys. So if you get a parking ticket, they can fight it. These people are using these MetLife attorneys. And these attorneys will not read minutes because they're only getting paid for MetLife minimum money.
Prepaid legal
so
fee.
And as I talk about when I teach due diligence in continuing ed, minutes can break a deal.
Yes.
Across the board. Okay.
So it's a team effort. We need the banker looking into the building, make sure for financing. We need the attorney taking a look at everything that they have access to. And not only that, I actually bug title. Sometimes I have agents pay, the $50 fee to have an examiner go out and see what's going on with, open permits or something that's going on with the CO. So for me, it's, you never want to scare the client. You want to at least advise the client that you have a team behind you that is going to know when and where to react to some of the yellow flags that we're seeing, and we want to assess the risk. And if it's something we can get around, we're obviously we're real estate promoters, right? We want to make sure that it's something that's not going to hurt them, that it's only going to empower them. And in many of these cases, there are things that can be easily fixed.
Yeah. Ryan, you were a developer before you became a superstar agent, and we love you. How do abatements, exemptions, and all that stuff affect long-term ownership costs when people are buying new developments? Okay?
Yeah.
I mean, abatements are gone.
Right.
But how did they?
Well, so abatements were an interesting tool. First of all, they incentivize developers
Yeah.
to build in the first place. And it's interesting because now you look at some of these buildings in Williamsburg or these parts, again, of prime Brooklyn where they used to exist. And now you can hardly imagine any developer needing a financial incentive to build in these places. But I guess back in the day, it was necessary. And over a period of time, they will burn off.
Of course,
Most
yeah.
types of them will burn off. Sometimes they're 15 years, sometimes they're 30-year abatements, et cetera. But when you're working with clients and you're looking at buying in a building that had an abatement, you have to study how much more time does it have left. If it already has started to taper off, how many more years, until it's fully gone? And what will those numbers look like? Again, we talked about comping not just your price per square foot of when you buy home to your neighbors, but what are your carrying costs per square foot? So you look around you and say, okay, when this abatement is done, am I going to be more expensive than my neighborhoods, or am I now my neighbors, or am I now going to be on par?
Absolutely.
And that impacts what your resale value is going to be, and a whole bunch of other things. So.
You're right about the abatements, but some of them, if I remember correctly, we had 10, 15, and 25-year. I'm assuming some of the 25-year abatements is still going on, right? Because new development isn't 25 years old in this town anyway. So they're going to expire. What's the thought, with, again, I think I asked you this before, John, going forward, people are concerned about, all right, I can afford today. I don't really know about tomorrow. And what happens when, by the way, when I was selling buildings that had 10-year abatements, and they, people lived there for a year, 2, 5 years. One of the greatest things about reselling one of those units was you can pass on that abatement.
Right. That's right.
4 years left, 5 years, people would run to this building to pick that up because they couldn't get anywhere else, right?
But if it helps you, this is the benefit of it, right? It's the developer can get this in place because then it makes it potentially easier to sell.
Yeah.
And if the purchaser is realizing, okay, I could own this, the abatement helps bring it down to an affordable monthly rate that I can afford. And I think that my earning potential will go up in the future, or I think that I will get some equity from this so that when it reaches the level of monthly cost that may be normal for everybody else, maybe still too expensive for me, but normal for everyone else, I could sell it. So there are a number of reasons why an abatement could work well. The problem is if you're looking at the abatement and you can only afford it with the abatement, and then when the abatement expires, if the numbers are astronomical, then the question will be, can you sell it, without taking a loss? But a lot of times a person is looking at their ability to leverage their purchasing power now with the hopes that their purchasing power will increase in the future. Because if they don't purchase now, then maybe the alternative isn't going to be to buy something without an abatement. Maybe the alternative will be to continue to rent.
Correct. Peter, as I said at the top of the show, unfortunately couldn't make it today. So take a crack at this legal question. Where do buyers most often misunderstand their legal and financial obligations after they close? We're all elated. We're all excited. We all, whatever, celebrate and congratulate closing. They move in, whatever. But what could potentially go wrong, or what could happen going forward from a legal perspective or from a financial perspective that maybe the buyer hasn't even thought about?
Yeah. So
wait, deepen your voice.
As here it is, in a world filled with legal problems. So as non-attorney, these are the legal questions that I hear people bring up.
Non-attorney, that's right.
So first of all, understanding that you as a co-owner in this building, assuming that it's a condo or a co-op, because if it's a house, that's you're just responsible for everything. But sometimes a purchaser thinks that it's in working condition now. If something breaks, then, oh, great, someone else is going to pay for it. Because when I was renting, someone else paid for it. And that's not always the case. So when you are taking on risk of things failing, not just in your walls, within the walls, from appliances, it could be the air conditioning, it could be, any number of things. But you also have additional liability if something originates inside of your apartment that affects somebody else. But then if the building in general has big issues, this is where, the buyer might think, well, I'm not going to be responsible for that. It's the building's fault. Well, you are the building. You are a portion of the building. So this is why it affects the finances too, because if it could lead to a major assessment or, God forbid, a lawsuit or anything else like that, you are now a portion of that entity that owns that entire liability. A lot of times the idea that, A fee could go up, a monthly common charge or maintenance could go up if the purchaser says like, well, I didn't agree to this. You know, when I signed the contract or when I made the purchase, it was this. This is illegal. I don't approve this. Again, this is something that they have to realize as part of the liability or the risk that they're buying into. And it doesn't mean you have to be risk averse, because again, there's sometimes greater risk in just not buying anything at all, because now you're risking not being able to take part in the appreciation. Yeah. But there are a lot of things that an attorney should be able to present to you, but as a buyer, you have to realize you are still taking on risk.
Ryan, after closing, how much protection does the contract of sale actually protect, or does it, the buyer after they close? You know, I talk about this when I'm teaching also. Buyers have the impression sometimes that, you know, that contract of sale is going to rule the entire, you know, duration of them owning that unit. Is that true?
Yeah, I mean, again, absent our attorney being present today, right. my understanding and my experience on this particular topic is that representations don't usually survive closing. So you say that your stove works and the AC works, and it might be, but the day that you close, if something happens and 5 minutes later, it's your problem. So, you know, the contract of sale is binding in that you transferred title, hopefully correctly. But aside from that, everything else that's in there, theoretically, you really don't have much teeth against. One exception being in new dev. Right. Sometimes, or often in new dev, we have what we call punch list process. You know, I'm representing one of the top new dev buildings downtown 16th Fifth Avenue. And every person that's buying these homes has to go through a methodical process of identifying, you know, there's this separation in the baseboard in the wall, or this, you know, et cetera, so that when everyone moves in, everything is like new. But you don't have that added level of contingency when you're buying resale, and I don't know that people always realize that.
They don't. And what red flags, you know, we talked about board minutes before, what red flags can come up in board minute readings by attorneys? And, you know, we're not attorneys, but we're agents who have to deal with the drama that ensues. What can pop up in board minutes that make a deal not want to happen anymore?
Yeah, I mentioned this earlier on, but this is a real thing. So co-ops especially will take out loans. Co-ops, I mean, some people are familiar with the nuances of how a co-op differs from a condo. We all know that it's essentially you're buying shares in a company that actually owns the property itself. You get a stock certificate. But since it's a company, the company will take out debt against the property to fund capital expenditures. That can be a way to alleviate the immediate financial burden rather than doing as aggressive of an assessment if something is needed. New roof, I think, was an example used before. So when you take out this debt, you have to look at this debt. How long is it? Is it interest only? Did we just kick the can down the road and we're going to have to refinance this debt and none of it's been paid off? And I took out that loan during COVID when interest rates crashed, and now they're more than double. I mean, you would know how the multiple of that, right? So I'm signing myself up as a buyer to have to refinance this debt and take on far more expensive monthlies. So that's one thing that you would look at in minutes. Lawsuits is another good thing.
Huge. Lawsuits are big.
Yeah.
Want to make sure
water
they're covered.
leaks, bugs, rodents.
Listen, can we talk
something
about
like water leaks.
Nobody's mentioned ground leases.
Oh, yeah.
No, not yet. Go ahead.
Okay, sorry. But like,
Never buying a ground lease. That's a simple answer. Renting one if you must.
I get the heebie-jeebies.
The ground lease is something that's so important because we're seeing some massive litigation in Midtown right now of a ground lease that, you know, expired and where essentially an entity owns the ground underneath the co-op.
Carnegie something?
I'm not going to say it, but
we all know where it is.
Sounds like
but people are like, people can't get rid of those units because they've, you know, I don't know, doubled, tripled the ground lease, and now the maintenance is going crazy.
Yeah.
And so I think that's something that when attorneys also are looking at the minutes to see when does that ground lease expire. It's also in a lot of the financials, but banks care about that obviously because, you know, the banks want to know that the client's going to make the monthly payment. And if they can't make their maintenance, they're going to have trouble making the mortgage. So yeah, all of that's very, very important.
But something like you mentioned, leaks. So this is where attorneys may see a red flag if in one of the meetings the idea of a leak is brought up. And then they realize, okay, leak, this could be an issue for the building. Let me go back and look at the budget. Have they already accounted for this? Oh, they haven't. Oh, wait, this means there's an expense that is forthcoming that hasn't even been accounted for. It doesn't mean it has to kill the deal, but then it begs the question, what other, you know, outside of the meeting, what other endeavors are in process to address this? And has there been a quote? Has there been anything? So that's the idea of trying to look out for these red flags. It could be like a minefield, looking for those mines and figuring it out. Some of them have already been calculated,
Right.
and some of them haven't been.
I had one experience with a water leak that came up in minutes where, and I always say, again, when I'm teaching, I say, anything a buyer does not want to hear about is water. When they hear anything about water, they run for the hills. Run for the hills.
Same with banks.
And same with banks. And this particular apartment had major water leak 2 years prior. No one said anything. And so the buyer said, I'm out. Because they review minutes before you sign the contract. Buyer said, I'm out. I'm not dealing with water. Look, it is what it is. All right. So what about offering plans, John? You do a lot of new developments like Ryan here does. What about offering plans? Is there anything in an offering plan that attorneys get squeamish about, that bankers get squeamish about? I mean, we all review the special risk section, but there's also a hell of a lot more to that offering plan than meets the eye. Anything there can create issues?
So
or does create issues?
I'd say definitely special risk section. One of the things that is very important to look at that will often come up in that special risk, but is identifying. I'll just an example. Do you have lot line windows?
Yeah.
The windows.
big one.
You think you're buying a 3-bedroom apartment. Is it really a 3-bedroom apartment, or is it a 1-bedroom apartment with windowed rooms that somebody put a bed in?
Right.
And in the offering plan, you can get a sense of whether or not the air rights have been purchased adjacent to the building that extend the required space to protect those windows from getting covered up. A lot of times in the special risk section, it'll note whether or not this particular wall is lot line window. Lot line meaning if the next door neighbor decides to build up a high rise, they could force you to brick up that entire window.
Thank you for clarifying. I was going to ask you to clarify for the audience. Go ahead.
So that's a great example of one. You might also have, they might also look for other things if they see that the building is cantilevered over another space, but they can't find any space anywhere in the offering plan that addresses whether or not they got the air rights to license to build over that space. Of course, we would all in the real estate world would assume they had to have done that in order to get the building erected. But there's a lot of stuff that doesn't appear when you're just taking it for face value as a buyer and you're showing up and looking at it. So a lot of things in the offering plan that are important. Also, when you are buying new development, let's say you're purchasing it with the intent to rent it out right away. Sometimes when you're purchasing in a new development, it is not allowed to buy and then to put it on the market to rent because the sponsor, reasonably so, doesn't want to compete with somebody else who's marketing it from day one. So a lot of things like this have to come up only in a very true, open and honest dialogue with your attorney and with your real estate agent. So if you intend to turn this into investment from day one and you keep it hidden or secret, don't get upset if you find out you've closed on it and now you're prohibited from marketing it as an investment.
I kind of want every agent that's outside of New York to kind of listen to this because here's the thing. Outside of New York City, or actually New York State, you're not required to submit an offering plan to the state. Sometimes it's municipality. So if you're an agent and you're selling new construction, condo, townhouse, any of that, you should absolutely be asking that sales team for their condo declaration or whatever they have, because now you could act like a New York City agent and do this diligence for your client. And you don't most of these places are not attorney states. So it's you, the agent, that has to look at all these things. Whereas in New York City, we have experienced agents, right? Only experienced agents can do new construction. But you also have an attorney. So it's one of those things where I always think about like your audience. I'm like, this is gold.
Yeah.
David, it's one thing that makes me laugh out loud sometimes when I'm chatting with other colleagues. Like, you want to talk about the wild, wild west. I can't even imagine working in the real estate industry anywhere without attorneys looking over us and making sure of whatever. Can you just imagine how these other areas? I know. I hear about it. I have friends who sell in Florida and tell it whatever. And especially when it comes to new development, it's like, wow, no attorneys. Okay, wild, wild west. We got it. On that note, we're taking another break. One last break. We're coming back. Our next block, we're going to continue with the total cost of ownership. This is Talking New York Real Estate on the More Network. Don't go anywhere. We will be right back.
Their phone or always leaves your text on red? Leaves your text on red.
Built a working group with $1,000 loan.
Tell us a little bit about how you actually came from.
Welcome to the build-up, John Roa.
Thanks for having me.
We're coming to you here from Studio 1873.
It's not 57% over 2.7 million.
So then, here, cheers.
Hi, I'm Dylan Pachulik, CEO of XL Real Property Management, New York's most trusted name in luxury property management since 2012. We specialize in managing individual apartments, townhouses, and rental buildings held by absentee owners. We maintain our properties with the highest standards of quality and service so that owners can choose a hassle-free approach to real estate investing. Rented or owner-occupied, we handle it all. For more information, contact us at xl-rpm.com.
Okay. So, David, we are back. David, how do carrying costs, assessments, and taxes impact? We talked a little bit about this throughout, but, a buyer's affordability. When you're looking to, qualify a buyer, you have to look at everything. Obviously, the monthlies, obviously the purchase price, their income, whether they have 401ks, et cetera, et cetera. What do you really need to have for loan approval, right? Because you got to send it over to underwriting, and underwriting's got to say, okay, yes, or okay, no. And sometimes, they'll approve the buyer. I had this happen to me twice in 24 years. They'll approve the buyer, but not the building.
Of course.
Yep. So we all know that can happen, right? What is it that what do you look for overall in a buyer's, qualifications?
So going back to that, remember, I always teach 5 things for mortgages. Again, the reason I'm so specific about it, credit, income, assets, building approval, and appraisal, is because if I call where I bank, I'm not going to say where I bank, but if I call them, they send me to Arizona, and the nice woman over there in Arizona is like, oh, you're buying a coupe, and they'll approve your loan, but 3 weeks after contract, they'll say we don't like the building because it has scaffolding or local law 11 or a bad budget, right? So as a New York banker, I do not release a commitment letter for the client until all 5 milestones are done. So that's number 1. Number 2, when it comes to actually qualifying a client, and I got to be really careful about the word qualifying, but in theory, we're going to talk theoretical here. When I'm looking at a client's financials, again, banks are very generous. Most Fannie Mae products allow you to spend up to 43%, even more than that, of what you earn on a monthly basis. And if you're W-2 gross earner, we use the gross number, right? On self-employment, we obviously net it out. So for me, we have very generous kind of parameters for most clients compared to what New York City market requires. When I look at the assessments, I care about, number 1, how long is that assessment for, and is the seller paying for it? Number 2, another thing we forget, I want to know how many people are delinquent on that assessment currently. If it's over 15% of delinquencies in the building, the bank's going to have an issue, right? When it comes to tax abatements, I get really specific. I'm looking at the timeline of where we are. We're in year 20, 23, 24, and I'm going to use not the current number of taxes or what the taxes are monthly. I'm going to look at what's in 3 years and 5. I want to see what the 3-year, what the client's going to have to pay in 3 years to know that we have enough room. And something we're all forgetting, everybody loves to push adjustable rate mortgages right now, right? But the banks don't actually look at your number of your monthly payment today of that adjustable rate mortgage. They're looking at what that adjustable rate mortgage can be if it were to adjust. So we usually qualify at 1% higher than the actual rate. So we're doing very conservative calculations from the get-go. I won't even get into interest only because that's a whole other ballgame.
That's another whole.
Yeah, but you can see we're already thinking ahead of what's going to happen to protect our client and protect that they're going to actually be able to make the mortgage payment with all of these variables changing.
Ryan, we've talked for years about, people usually live in their apartments 5, maybe 7 years before they trade up, trade down, move out of the city, whatever. When you're working with buyers who are buying, and of course, everybody thinks they're buying their final home, and it's got to be the most perfect home. I'm never moving again. This is going to be where I'm living. And I'm like, okay, right. Especially a 1-bedroom. You're going to meet somebody. You're going to have kids, whatever. It goes on and on. When you're dealing with people, from a total cost of ownership perspective, and you're trying to make them understand, yes, it's an investment. Yes, you want to do the right thing. Yes, you want to pick the right banker, on and on and on. But do buyers think about time past 5 years or past 7 years, or do they really still say, my final home, this is it, not moving?
I think, and Whether or not they think about it, it's your job as a good buyer's rep to bring it up and make sure that they think about it. You have to ask them about timeline, about investment intentions, about life goals, so you can help program what will ultimately be a good buy for them. But it's interesting because we keep talking about, as is the topic of today's discussion, the cost of carrying. But one of the costs that we don't really think about is the cost to get in and the cost to get out, which amortizes over the lifetime of ownership. Some of the biggest expenses are fees that you pay, taxes you pay when you're buying, your mansion tax, your transfer taxes if it's new dev, if you're mortgage recording tax, if you are in a building that has a flip tax, and then of course those pesky brokers when you go to sell, you pay our commissions, or it could be, as we know now, on buy side as well, but predominantly on sell side historically. So in any event, you have to add that into your calculus. Am I going to be able to exit for not just to make myself whole for all the years of the carrying costs, but also am I going to make back all the fees I paid to buy in and to get out?
I mean, because years ago you buy something for, let's use $200,000 as an example. When I first started,
years ago.
It's a lot of years. Well, I'm using me as a personal example. Okay, so I bought a one bedroom for $220,000. Oh boy,
God bless you.
Good for you.
And a co-op, whatever. But I happened to catch the market. This is before I was a real estate agent. I happened to catch the market as it was going up. So incrementally every year, every 2 years, and I was on this plan to sell every year or year and a half. It made all of my family and friends nuts. Why are you selling? What are you doing? Well, I can make $200,000. Why not?
Yeah.
And buy the next one, and buy the next one, and buy the next one. Okay, that really doesn't exist anymore. So I think the total cost of everything that you're involved in ownership today makes a difference. Back then, maintenance was low. It was a co-op, so I didn't have real estate taxes really. But if I knew I can sell after a year and make $150,000 or $200,000 because the market went up so quickly, right?
Yeah.
That doesn't exist anymore. John, though, are there building profiles or ownership structures that are more resilient to these rising costs today in the new world, or are they all basically the same?
Well, the majority of ownership historically in the city has been in the co-op side. And one of the benefits that was historically useful was that it was tightly run. You are shareholders in a corporation, and so they were trying to protect the cost. So frequently, when I have clients in the past that have looked at co-op versus condo, we might look at the maintenance and realize, oh, this maintenance is a little bit lower than the combined common charges and real estate taxes. There are other issues that you have to contend with, though. Liquidity. Do you ever plan to lease it out? And most new buildings now are not co-ops; they're condos. So when we're looking at ownership style or building profile, I think you really have to compare it to what you need to live. Yeah. If you're comparing it to a rental building that's a full service rental building, then you might realize that there's benefit in purchasing. Yeah. For example, we talked about the cost to sell, the overall closing costs. Let's just pretend that you're going to budget 8 to 10% in closing costs for something. If you were to purchase, you have a number of other benefits. The SALT deduction has gone up, so you can write off more of your interest and real estate taxes. So that number's gone back up.
I think that's going to be a game changer.
It's gone up to what is it, like $40,000?
So it's up to $40,000, up to $500,000 in earnings.
And it was only up to $10,000 before,
it was 10, right?
Correct. Which was a disaster.
So this is going to be huge.
So the reasons to own could include not only appreciation, which is great, but also debt reduction. Yeah. And then if it's an investment, you have other things. But with that appreciation, let's look at what's happened in New York City. We are probably averaging in the 4 to 6% appreciation range. If you go back just a few years, maybe it's closer to 3 or 4%, but over a greater span, it's probably closer to the 5 to 6 or even 7%. Yeah. If we look at, if you were borrowing on $1 million purchase, let's say you're borrowing $800,000 at a 6% interest rate, that's like $48,000 a year. If you were increasing that $1 million purchase because you're leveraging at 4 or 5%, then maybe that appreciation comes out to close to $40,000. Yeah. So really, it could be that your total cost on the interest side is $8,000. You have your common charges and real estate taxes as well. That's usually significantly less than what it would cost to rent. As time goes on, the amount that you put towards interest is less and less and less because you're paying down. So these are there are a lot of other calculations, but ultimately you have to look at all of the things. What's the building that I want to be in? Long term, how long would I need to potentially hold this to get my money back out? And then how long could I hold it until I could theoretically make a little bit of profit and buy up? And then at the end of the day, there are no guarantees. You still have to be okay with the fact that maybe it won't appreciate at all, but at least I'm living in the building that I want to live in. I have the amenities, the proximity, and everything else. But there's a lot of benefit in owning. You just have to look deeper at the math and then at your lifestyle and find a way to marry the two.
I like when you referred to lifestyle, because that has a lot. I'd say 50% of it. Of course, the financial is important, but 50% of it is lifestyle. Ryan, let me ask you though. So, we have co-ops, we have condos in this town. We'll keep townhouses out for a minute. In your orbit, where are your buyers looking more, at co-ops or condos, and why?
Most of them are fairly ambivalent, and and co-ops. It's been mentioned earlier in this discussion about how co-ops make up about 70%. I think you said of the transactions, so you kind of can't avoid them. However, I tend to find that some of my ultra high net worth buyers, people who are international, that for either of those reasons don't necessarily want all their financials exposed in the co-op board process, are going to prefer very dramatic. It's very invasive, or they would prefer to go for a condo structure. And conversely, when I deal with first-time home buyers who are maybe more budget sensitive, you tend to find that co-op product is a bit more affordable than condos, so that actually there's more options for people who are just getting their first home or have less to spend. So that's usually where I see it kind of bifurcate.
David, if you could give buyers one piece of advice, to avoid financially overextending in their ownership in New York City, what would that be?
For me, it's really focus on the monthly budget that you think you're going to be comfortable making every single month, right? And then kind of from there, there's so many more benefits that they're going to get from the equity, from feeling they have a foundation as a place, but also some of these tax benefits we're talking about, the mortgage interest deduction, the state and local tax or SALT deduction that's going to be coming. And also, we cannot diminish. Look at all the buyers that bought in the last 2 years where rates were above 6.5 to 7. And we're already refinancing them right under 6. Right. Right. So
as
think
we've
about.
all said for 2 years, you could refinance when the interest rate gets better.
And I'm never going to say that. I hate that stupid term, pardon me. But there really is something with that. We're in a downward interest rate cycle at the moment, and so many of the people that bought a year ago, 2 years ago, are getting to take advantage of it. So I think focus on the number one thing, which is your budget, and don't go crazy. Here's the best part: you don't have to hit the nail straight on the head the first go around. This is your first time. Like, there's room for you. You don't have to get the lowest perfect rate. You don't stop going crazy. Focus on your team, get the guidance, get the trust, and you're going to be put in a really good situation, because you can see everybody on this panel. We all listen and we want to do what's right. We're not in this for one deal, hit it and quit it.
We're not transactional people.
Correct.
We're relationship people. I live by that. You hear me every week say the same thing. Okay.
And sometimes it's better to buy the ugly house now so that you can buy the dream house faster.
Right. You got to start somewhere.
Build the equity. Yeah.
All right. So, John, what questions should every buyer ask before they sign a contract? After they talk to their mortgage financial person, he says yes, or she says yes, whatever. What, questions should every buyer ask before they actually sign that contract and then move into, whether it's the first time or second or third time, into home ownership?
Am I excited about seeing myself walk in and out of these doors every day? Am I able to sustain? Am I able to afford this? Am I excited? And it doesn't have to be a permanent forever place. Right. It's just the idea of, for the next few years, am I excited about this being my daily walk, coming in and out of these doors?
You're reading my mind, because I tell buyers all the time, if I do my job right at the end of our transaction or deal, whatever you want to call it, and you tell me the first night you sleep in your new apartment, you put your head down on that pillow and you say, I did the right thing. I made the right call. I love this place. I feel financially okay with it all. Then I've done my job right? And I think we all can agree, from a mortgage banker perspective, agent perspective, we all can agree there's nothing better than that, okay? Especially in a relationship business where we want to make people happy. We want to sell them their chosen home, and we want them to come back to us at some point in the future, and certainly referrals. Ryan, so the rental market's been super, super hot, high prices. I just renegotiated a lease for one of my condo owners. My tenants are renewing, and they got a significant increase from 2 years ago. And I said to the owner, I said, we have to understand something. You know, they've been here for 5 years. They're really good. You know, we don't want to run the risk of losing them. They know they're going to get a little bit of an increase, but we don't want to piss them off. Excuse me. And he's like, no, I know. So we came up with a number, and I said, okay, well, I don't know about that. So I went back to the buyer, to the renters, and they are two great guys in this apartment. I just love them, and I see them every time I'm in the building. Actually, I work in that building a lot. And I went back to them and you know, in my own way, and I explained it to them and whatever. And they said, okay, well, why don't we kind of meet in the middle, the renters? Why don't we kind of meet in the middle? So it was a matter of a few dollars, and we met in the middle. And the owner, you know, that night I'm texting, he's in London, said, let's do it. I felt good. The renters felt good. They're paying a significant increase. But, I mean, it's market rate. You know, it's a condo. And everybody else in the building, since they took their lease 2 years ago, you know, whatever, have been higher. I guess to David and to you, Ryan. So why aren't renters deciding maybe it's time to buy, maybe it's time to kind of give up my rental at this new increase, this you know, crazy number, whatever? Is it because they can't afford to? Is it because they don't want to? I mean, there are people in this town who really don't want to buy.
I mean, one of the great issues for homeownership is not the ability to service a mortgage, it's the down payment. People don't have the savings to put down that initial deposit.
Absolutely.
I was fortunate to be a fairly young homeowner myself, and I remember at one point I had a bunch of friends, and I was hosting, you know, maybe it was one of my first couple weekends in my house, and I was looking around. I have friends with great careers, good degrees, that are making great incomes, and I was the only one that was a homeowner. And it wasn't necessarily because they couldn't afford to carry my home, but it was because I was the only one that had the deposit to get it. So that is the major reason, I think, or I'm quite certain, that is preventing people from making that leap from the rental side.
Agree?
I totally agree. Yeah, I was fortunate to have a home at a very young age as well, and I had friends that rented rooms from and with me. And it, I think, stems from the fact that my father was a real estate agent, and through his retirement. And I just think that there's something amazing about ownership if and when you can. 2/3 of our population in New York City rent, and I understand why. It's a very transient city. Sometimes people come in, they know they're only going to be here for a year or two. But if and when you decide you're going to stick around somewhere, I'm a big advocate of trying to get some of that equity.
I ask clients, like, I always ask for the warm and fuzzy, like, what inspired you to start your search? And I'm expecting like this American dream story, right? And it's always like, I'm tired of paying rent. And I'm like, okay. And it's the truth. And here's the reality. A lot of my first time buyers, I'm going to say over 80% of them, they are getting some type of gift from family members. And we all think gift tax. I want you all to research the estate transfer within a lifetime. And that estate transfer, so when someone passes, there's a limit of how much you can transfer, and it's in the millions of dollars without getting taxed by the government. You're actually able to do that while you're living. So we're seeing a lot of wealthy
you learn
families.
Something every day. That's why I love these guys. Okay, so I didn't know that.
Yep. So we have a lot of families right now. I have like people, I have kids literally right out of college, 25, 26. They're making only $50,000, $60,000, and mom and dad are transferring $1 million for down payment, and they're not getting taxed by the government. Even though we call it a gift on our board package and on our mortgage applications, when it comes time to the IRS, they're calling it the estate transfer within a lifetime. So this is where...
Or a loan. Sometimes it's the parents loaning the kids money.
A loan that you never pay back.
No, there are other internal things.
Correct. But you're seeing this wealth transfer like crazy right now because the parents are looking at them and saying, we have all this money. That generation has just amassed massive amounts of wealth, and they're like, we cannot see our kid paying $3,000, $4,000, $5,000 in rent.
All right, last question, John. So we talk about this on every show lately. Where do you see 2026 going? What's the state of the market as we enter new year? I mentioned before, I think it's going to be more of an inventory problem than an interest rate problem. Where are we going?
So I've already seen this. I've already seen some of the buyer activity pick up. I'd say even earlier in the year than what is historically the case.
Agreed.
Spring season is typically when things really, the fire lights and all of the buyers are out. We have something recently that went into bidding war within one day on the market with 7 offers. I mean, so I think that going into this spring season, we're going to see a lot of activity. And a lot of activity does sometimes drive an increase in price. So I think there's a good chance that along with some of the comfort with where mortgage rates have been, will drive a pretty robust buying season for the city.
Ryan, same?
I would say the same thing. I think it's going to remain fairly strong for many of the reasons you mentioned. I don't think debt's going to be getting any more expensive again than where it was. If anything, hopefully, maybe it will, not immediately go down, but heading in that direction. Limited supply is going to sustain pricing levels, if not keep them going up. So I think it's going to be pretty active.
David?
I saw a huge amount of bonus money come through the last few months. And also our clients that get paid in stocks, they're sitting on a non-diversified portfolio of restricted stock units that just got vested, and they're looking to diversify themselves, and they're liquidating some of their holdings in their companies, and they're buying. And so for me, I'm seeing the first-time buyer that's tired of paying rent, that has amassed some type of asset through either bonus or through stock or through family wealth transfer. Right. I think we're going to see more first-time buyers than we ever have this year. And then pair that with the downward cycle of interest rates. I don't even want to get into all the things that are happening there, but I think we're going to see this create a lot of multiple bids. Unfortunately, we're going to probably see a lot more, non-contingent contracts, and I think we're going to see prices drive up significantly this year, unfortunately.
Couldn't agree more. All right, that's our show for today. We'll be back in a minute with my final thoughts. David, Ryan, and John. Wow, always three of my favorite guests. We're coming right back after these messages. Don't go anywhere.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com. or email us at staging@theeverset.com to request a free proposal.
Okay, everybody, we are back with my final thoughts. So owning in New York City isn't just about getting in the door, it's about staying in comfortably. The true cost of ownership lives in the details, carrying costs, assessments, taxes, and insurance, all of which can quietly reshape the economics of a deal long after it's closed. The smartest buyers aren't just focused on what they can afford today, they're planning on how a property performs over time. In a market as complex as New York, informed ownership isn't optional, it's essential. That's how you protect your investment, your lifestyle, and your long-term financial health. And that's it for this episode of Talking New York Real Estate. As we head into a new year, and as I've been saying, it's not about grand promises or overnight change, it's about intention, choosing clarity over noise, growth over comfort, and being deliberate with how we show up every day. Thank you for listening, watching, and being part of the conversation. If this episode brought value, share it, subscribe, and keep asking the questions that matter. Until next time, stay informed, stay intentional, and keep finding your space. And you can follow me on Facebook, on Threads, Instagram, LinkedIn, Blue Sky, Substack, or TikTok at Vince Rocco. And Confucius says, choose a job you like and you will never have to work a day in your life, and the only person you should try to be better than is the person you were yesterday. And from all of us here at Talking New York Real Estate and the More Network, to all of you all around the world, thanks for spending a part of your day with us. I'm so grateful. Keep thinking the good thoughts, and I will see you next time. Goodbye, everybody.